and then you'll pay us back over time as you earn income. That aligns incentives and hopefully makes the school accountable for your earning potential. So there's plenty of players out there doing that. That's the student realm is not where we want to get into. But that being said, we're looking at MBA programs to say, look, MBA candidates, you want to start a business. Here is, the first 50K or the second 50K after you put in your own money or mom and dad's money. We'll come in and we'll invest in you and your business or your creator agency, whatever it is. And you're a pretty good bet. You have an MBA, you've got great earning potential. That's a great bet for us as an investor.
Fantastic. We're out of time, Will, but great job. I hope everything's well in California right now. So thanks so much.
Yeah, appreciate it, Marty.
Chet White. Chet has a long career in the securities industry and was a leading analyst in media and technology. And so Chet, why don't you introduce yourself? I think you've got a slideshow you want to pull up.
Sure.
And if we can get the camera person to redirect the camera to Chet, who's sitting here, that'd be great.
And use this.
Yes, use the microphone.
There we go. Perfect. Okay, well, thanks, everybody. I'm going to sit down and just stick close to my mouse so I can run through the slide deck. But I just wanted to thank everybody. I run the Helios Alpha Fund, and it's really an honor to be here with so many super smart people. Marty, you put together a tremendous group as usual, and it's a pleasure to hear and listen to all the great opinions and insights today. I can tell you I've picked up quite a bit already just to do some thinking about. From our fund's perspective, you're going to probably look at me as somebody who's a little bit overly optimistic at this current time. And I would say that from the perspective of it's quite a magical time. Over the past 3 years, with the market getting so expensive, there was not much for a growth tech guy who appreciates GARP, right? Value investing was kind of out of reach, and it was really time to be net short. And as our funds really uses the hedging tools to cut risk, but in reality, our mission is to find the next Amazon and the emerging growers, right? So I kind of look at today's opportunity as fantastic because we've been patiently waiting for about a year and a half to 2 years to get to this point. So I'll kind of start with that just to give our perspective. I think we heard a little bit of that as we talked to some of the groups this morning that particularly in tech, whether it's green tech, med tech, enabling tech, or fintech, the pullback in tech is about 75% deep. And you can definitely now begin to look at what does this company really do? What's the cash flow look like going forward? Because you're going to be able to find, I think, the right companies through the bottom to the next upcycle. So that's kind of our market stance. In perspective, as Marty mentioned, I've done this for a long time. I started in 1986 at Payne Weber, which became UBS, and then D. Witter, which became Morgan Stanley, and have stuck with finance in the tech side of the world, institutional tech side of the world, since 96, for about 25 years. I was a sell-side analyst through the internet bubble. That's where I kind of got my experience on Wall Street, and have stuck serving that group in tech for the past 25 years. And it really worked as a fundamental research analyst, taking the GARP strategy for all of those years. Have certainly learned the long short side of the business as I've grown a fund since 2008, and have learned the structured capital side of the business as another great way to protect capital in some of these emerging ideas. And our fund also does take active roles, really like almost like a public venture capital structure. And we sit on our boards and we drive change if change needs, or in most of the companies at that young stage, they need some type of helping hand. So we have a good group of advisors on the fund who are generally ex-CEOs who I've worked with over the years, and they really do roll up their sleeves and help these companies grow. So that's kind of my background, and that those tools, we still use all of those tools throughout our fund to really drive the growth. And you can imagine the macros, you can see the charts. There was it's been a good long bull run, but our mission is to mitigate the downside, right? So when the market pulls back, we really want to have some short long structure. We want to have some convertible debt structure to kind of buffer that downside pullback, because if you've seen kind of growth at any price, like their ARC funds, has been quite painful, right? And so our mission has been really benefited from being very risk aware. I guess that comes with old age and being 3 or 5 years in the business and going through so many cycles. Things become pretty clear when they're overpriced, and they become much more interesting, like right now, where I'm going to say they're fairly underpriced, right? So it's a good time to start rolling up your sleeves, really dig into the fundamentals of which are the next innovation companies to come. And there's quite a few that are on sale right now. So just because it's such a timely subject, I want to at least put in our 2 cents how we saw both the tech bubble, the crypto bubble, and the main bubble, which is really not, it's inherent in a speculation bubble, right? We just had it. It was blatantly clear. There was not much that wasn't terribly obvious to somebody who was reading and paying attention in any way. You had all the red flags with famous people pumping things, right? It was not rocket science to figure out, okay, things are getting a little out of control. And here we sit, both the tech bubbles kind of deflated most meaningfully. The main bubble was probably the most obvious, right? As you look at some of these businesses that did not have strong fundamentals in any way, right? And the crypto bubble was more complicated in a sense that it had some fundamental dysfunction in, all the things that are not regulated that should be. So I'm a big proponent and super excited that regulation is coming about, because you have some of the strongest institutions in the world coming into this space, and you have to say, why are they showing up, right? Why are these guys coming in, spending their valuable time, resources to take advantage of some of these features that we look for in the mission to do something cheaper, better, and faster, right? And so whether it's the automated smart contract in Ethereum, whether it's the frictionless exchange, kind of a Bitcoin, or the decentralized ledger or tokenization, all of these things are the fabric of fintech, and the fabric of what's going to make things cheaper for everybody, right? So with that said, that, in my personal opinion, as we kind of clear out the frauds and scams and the schemes, and you get down to the technology that all these institutions showed up for, and you can count on your capital to deploy properly, you're really going to have a exciting time in fintech. And I think we had some super smart individuals come and talk about, well, how do you unwind this FTX environment? How long does it take? Bernie Madoff took years, 10, 13 years, right? It's still going on. How long will FTX take? That's tough to say. So is it, the time to go and load the boat? I would say it's a little bit tough to make that call at this point, because there's still a lot of stuff that needs to happen and a lot of laws that need to get written. I can't agree more. And that's going to be a process. But as we get there and things solidify, particularly maybe starts with the bigger Bitcoin, Ethereum markets that are more scrutinized and have been more institutionalized, maybe it begins there, kind of like in this pullback. Where do you go first? Where are you going to go to the bigger companies, right? You're going to go to where the EBITDA is positive, right? That's where the picking will start. And where do you go in the crypto market? You'll probably go to the big ones, right? Ethereum and Bitcoin. So I just find this to be very telling. Why we have lucky enough to have Tim Draper here to speak about this in more detail, but you have not just Tim, but a whole industry of smart people recognizing the strong value of the potential to really cut out the middleman and to some degree automate a lot of this finance and very cost effectively. So again, I'm kind of positive, but I think we're still going through I call it bursting or cleanup time for crypto. But I can say on the main side of the fence and on the ARC side of the fence, in my personal opinion, we're largely there, right? And I would kind of look towards some of the people who are much smarter than me and have a little humility about this. And I love Jeremy Siegel. I think he's spot on. And we have a fellow Wharton guy for you, who, in my opinion, really gets it right. And he's, just stating the obvious, but, the Fed is really behind the curve and a little bit too backward looking. The oil prices and the leading indicators are coming down. It's just a matter of time to just cascade the following indicators. So that's taken its course. And you have to remember, the tech market lives 6 months ahead. So we're already in the summer of next year, right? We're there. So sure, there's going to be some more earnings to unwind in the coming quarter, right? Maybe Q1, but the market's already out in June. And the oil prices you can see are coming down. And what are we shorting today? We're shorting oil, right? What are we looking to sell at a peak price? Occidental, right? And we believe that not only is that oil price peaked, not peaking, it's peaked, but there's some real secular headwinds to go green, right? So as somebody who's a green tech investor, I love to see that. I want sustainability to become very cost effective. And with that in mind, this is, I said, a bit of a magical time, right? Because oil has been really strong and Oxy has been one of the best performers. Warren Buffett's no dummy. But with that said, it is now peaking out, and I don't know, what's he buying lately? Taiwan Semi, right? So I think it is time to kind of take advantage of that transition. And where do you go? Well, on the other side, Kathy Woods is no longer buying at any price. She's buying at a cheap price, right? And whether you're looking at the biggest ones and you stick to ones and cherry pick your favorites, like a Shopify going through the holiday season, some nice shopping, or you look at a Teladoc, because I'm a big remote healthcare fan, with one of our core positions, a smaller one called electricity, but recognize the power of Livongo doing continuous diabetes care, or RPA with UiPath for robotic process automation, teletherapeutics with CRISPR. I think right now you can go through that list and cherry pick your very biggest and favorite tech companies at a 5-year low, right? So that's what we're looking to. We've been net neutral and really leaning on our convert architecture with a little bit extra cash, no leverage. And right now, these things are all at 5-year lows and pretty compelling in our personal opinion. And that's why I say this is a great time to be a GARP tech fund, right? Because the store was really closed until we came to this somewhat of a bottom. And I think I pulled the chart from the 2001 bubble, or the 2001 bubble. And we had about 3 to 6 months to go. I think last time we talked in New York. And we're just, we're pretty much just about there now. Things have unwound. With all the pounding that may come out of the traditional S&P 500 stocks and some more earnings cuts coming out of the S&P, it's already come out of tech. I mean, you're already there, right? Down 75%. I don't know, maybe you'll get down 80%. You can put it 3 bids in at different lower prices. But if you spend the time, and our mission is to do just that, I think you'll find your next 3 to 5 years worth of return down here. And I guess, and I don't think I'm being terribly optimistic. I think we saw a little consensus from some of the others. Their question was, and it's a valid point, how do you judge what's going to happen when the earnings come out, a little bit of earnings come out in Q1, Q2 of next year, right? Will that pull it back? It probably will. But to some degree, I don't know how much further it's going to hurt Shopify. We're Teladoc down from $300 to $26, right? I think that you might take a little bit of it out of NVIDIA, who still has come down modestly at 50 some odd %, right? But that's where that's where you have to be a bit selective. So we find this to be a exciting time, a super exciting time, and we waited patiently for it. And we're really trying to figure out which of these can be the next Amazon, Google, NVIDIA, Tesla. That is our mission, to go kind of a little bit sub-institutional if we need to go where there's somewhat more innovation, to just anything in the small cap, micro cap world, right? Where you're going to find something who's small enough, under $1 billion, that can become, multiple billions, tens, if not $1 trillion, right? So those are the areas that we're looking at. Generally, when we go, the smaller you go, the macro becomes much more critical, just like in venture capital. You have to have it cheaper, better, faster. The older I get, the more I recognize cheaper is critical, right? You got to have price in your corner, and if you can add better and faster, you have a home run. So like as a fabric of stuff that we look at, but you do need to have the macro at your back, because all these small companies, they stumble, they fumble, and they need a hand, right? They need more money than they thought. And so having a good space, whether it's EV, or whether it's artificial intelligence or DNA sequencing, they'll get a bit more leash, right? And the markets will get a bit more forgiving, because they appreciate that this is a good growth area and capital will be available to them, right? So as we look at these sub-institutional stocks, we'll say under $1 billion, we definitely look for a strong macro, of course, with all the other basics that you have, right? Cheaper, better, faster, as in they're going to cut the cost of that good by half, right? And if you can do something like that, or a combination of increased revenue and cost with strong patents and all the basic stuff that you would imagine you need. So that's kind of where we are today. And that's the door that's been opened in the last, couple months, right? And will it open a little bit wider? I'm not smart enough to say, but I can know this is the time to go looking and roll up your sleeves. And what are some of the things that make our fund special to go even earlier than a traditional hedge fund like Citadel, who's going to come down here and have a big operation shortly, if I'm not mistaken, right? Well, buying through the trough in good macros is kind of the first step, because you can buy a little bit bigger and you can still make a really nice return, right? So that's, I think, going to give us common to better than average results. Buying at any price is a really bad idea, as we've seen with the ARC funds. So, we're there, and it's time to start buying. In terms of hedging long short, we're running a little bit light on stuff short, right? Could you short into an Oxy great quarter? I guess, right? So is it as compelling as some of the stronger shorts that you get when you have a really flawed fundamental business model? Not as compelling. It's solid to maybe at least unwind some of your long in oil, right? And where do you want to start going? You want to go into tech. So that sector rotation is certainly a good idea. And what we do when we go smaller is we generally add structure. So by structure, we invest in debt, and that debt will have all the benefits of being, first lien. It has a good yield, an exceptionally high yield of 20-25%, but it's gets 100% of the equity right. So so when we go particularly under $250 million, it's always structured, right? And then as it grows and matures, and becomes institutionalized and can get the C of NASDAQ type of capital at a fair price, we invest all the way through into the NASDAQ round to get them well on their way so they absolutely don't need us anymore, right? That is a full cycle for us. And I mentioned the tenure that I've had doing this for quite some time, in terms of 25 years of institutional work in tech. And I kind of cut my teeth working on a company called Redback Networks, where I learned the tough lesson and also learned the good lesson. And that was a company that was backed by Sequoia, who unfortunately just wrote down a big chunk of crypto. But with that said, in that time with Redback, we were one of their best recovery stories, where they didn't have to write down an asset. They basically, there was a bit of competition between them and Juniper Networks in the day to win edge routing for the telcos to fight cable. The net of it was Juniper did not have a compelling product. It was twice the price and half the performance, but they gave it away to Verizon and really put them into bankruptcy. And with that, Sequoia was the biggest holder. I think they had a $500 million convert at the time. They restructured it, but the cheaper, better, faster won out materially. And they brought in a good friend and tech investor with me, a guy named Kevin Lanuccio. And basically Kevin and his team, I think, had one of the fastest growing tech companies I've ever seen. They went from zero revenue to 400 million in 18 months. And that drove the stock from $1 in a very distressed environment. And I think it was TCB who did the pipe at the time, from $1 up to 24 and an exit 18 months later to Ericsson. And so that's where you kind of learn about structure, you learn a little bit about stress, and most importantly, you learn about good tech at good prices. And I think we've gotten one of those times, and maybe it'll be in the deepest distress will come in crypto, right? Where you have such kind of noise coming out of it, and you may find that you get to buy of a lifetime, whether it's, and it's difficult for me to say, is it Ethereum or Bitcoin or one of the green coins, because there's quite a few low energy green coins coming, presents this incredible distress opportunity in tech, right? But certainly that's kind of where we got our vision to build this fund. It was a very underserved, under really $500 million market. The capital, the research, and the resources aren't really there for these companies. So we provide it, but not in a predatory lender manner, but in a scaling manner, right? We're looking to help companies scale, right? And that is very different than the other capital that's floating around in these small companies. So we find good partners who join us, and our mission is one, very much so, I call it off-grid to on-grid, to get these companies to scale.
Are these over the counter? What types of listings are these?
Yeah, generally you're coming into something that's over the counter, and it has a structure in which would align them to go to NASDAQ. And probably within two financings is a very perfect structure, is a perfect setup. One, we'll call it like pre-IPO, like we would perceive it to be pre-IPO, and one IPO, right, to NASDAQ. So that's kind of the mission. You would come in convertible debt in the pre-IPO, which is like a D round or a C round or B round, and then you would go IPO with a NASDAQ listing. So that's kind of the architecture which we use. We've completed that architecture with Biotricity. As I said, we're very excited about them. They have a continuous monitoring device for cardiac surgery. They've now matured. They're up on NASDAQ. They went to, we'll call it IPO from Bulletin Board with AC Wainwright. They've raised 25 million, and they're on their way to really becoming a solid company. Their revenue's 10 million. I think heading to 50 as they've expanded their market share from $1 billion, or their TAM from $1 billion to 35 billion as they've gotten to continuous care. So that's a really good case study, like a Redback, or we had Coursera Networks was one of our early ones. We have a little company called Pebble, which is probably the smallest one I've worked on. But again, it's still in the convertible debt stage, but they do, maybe you'll hear this more, sustainability as a service, a SaaS play. And that is one in which has serves the EV charging space, which is a very difficult environment. It has to be highly subsidized, as you know, and it's a big shortfall in there's massive demand per se, but it is a 40% gross margin domain. This is an umbrella strategy to build a SaaS 80% gross margin overlay on all the charger companies. And this is a tiny little $10 million market cap thing. So we will go early, but only with structure and with something that is big enough to go institutional within the next 12 to 18 months. So that's kind of what's quite special about our fund, the fabric of what we do to minimize risk and maximize return. And I appreciate your listening, taking a look. And if there's any questions, I'm happy to answer any further questions.
Any questions? Chet, I think it's really fantastic because we learned from like post 2008, and there was like this, real valley of death in the healthcare industry. There's always new financial engineering that comes out that allows companies to figure out how to restructure, how to get growth capital. So I think that we're in intriguing times. I know that your firm is really a leader in some of the stuff that you're doing with finding growth capital for